Debt or equity? Debt is cheaper until repayments crush your cash flow. Equity feels safer until you realize how much of the upside you just gave away. And here is the problem. Most business owners make this decision based off fear and not strategy. They either avoid debt because it sounds risky, or they give away equity because they need cash today and do not think about what that costs them in 5 years' time. So in this video, I'm going to walk you through the exact framework I use with clients to figure out which path makes sense: debt, equity, or a combination of both. We are going to cover the 5 questions you need to answer before raising any capital, the hidden costs most founders miss on both sides, and when a hybrid approach actually makes sense. And I'll be honest with you, after working with thousands of business owners, I've seen people get this decision catastrophically wrong. I have also seen people use debt strategically to scale without giving away a single percentage of their business. And that changes everything for them for the future. So let's get into it. Before we get into the framework, let's make sure we are on the same page with what these two terms actually mean. Debt is when you go to a bank, a non-bank lender, or any type of financer and you borrow money. You pay interest on that monthly amount and you pay it back over time. You keep the full ownership of the business. Equity is when you sell a portion of your ownership in the company in exchange for capital. No repayments, but that person now owns a part of your business and is entitled to a share of the profits and potentially a say on how you run things. Now, here is where most people get it wrong. They think of this as debt equals risky, equity equals safe, but that's not how it works. Debt has a fixed cost. You know exactly what you're paying. Equity has a variable cost, and that cost can be enormous if your business grows. Let me give you a simple example. Say you need $100,000 to scale. You could borrow that at 8% interest. Over 5 years, you might pay $20,000 in interest. Or you could give away 10% of your business for that $100,000. Sounds reasonable, but if your business grows to be worth $5 million, that 10% is now worth $500,000. You just paid $500,000 for a $100,000 capital injection. That is the real cost of dilution. And most founders do not think about that until it's too late. So how do you actually decide? Here are the 5 questions I walk through with every client before they raise any capital. Question number 1, what are you going to use the money for? This sounds obvious, but you would be surprised on how many people skip it. If you need capital for equipment, vehicles, or assets that generate income, debt usually makes sense. You can finance the asset and the asset pays for itself, and you keep full ownership. If you need capital for something speculative, like testing a new market or a product that might not work, equity might make more sense because you are sharing the risk. Question number 2, can your business service the repayments? This is the cash flow question, and it is critical. Before I recommend debt to any client, I want to see at least 3 months worth of operating expenses sitting in a cash buffer. Ideally 6 months. Why? Because debt does not care if you have a bad month. The repayments are due regardless. If your cash flow is inconsistent or seasonal, you need to stress test this properly. Ask yourself, if revenue dropped 30% for 3 months, could you still make the repayments? If the answer is no, debt might not be the right move. Question number 3, what are the hidden costs on each side? With debt, the hidden costs are things like establishment fees, which are usually buried in the fine print, personal guarantees, which means if the business cannot pay, you are personally liable for the finance repayments, balloon payments at the end of the loan term that catch people off guard, and covenants, which are conditions the bank puts on you that restrict what you can do with the business. With equity, the hidden costs are dilution over multiple rounds. Control rights, where the investor gets a say in decisions. Reporting burdens, where now you have to keep someone else informed. And decision vetoes, where they can block you on things you want to do. I've seen business owners give away 20% in an early round and then another 15% in a second round, and suddenly they own less than half of the business they built. Question number 4, what is the real goal here? If scaling fast is the priority and you need to preserve cash for marketing, hiring, and operations, then financing assets through debt keeps your cash free for growth. I'll give you a real example. I had a client running an electrical business. They grew from 3 to 15 people in 3 years. Every time they hired someone, they needed a new vehicle, new equipment. If they paid cash for all of that, they would have drained their reserves. Instead, we set up a facility with the bank where they were pre-approved for a certain amount. Every time they needed a new vehicle, they would just send the invoice to their banker. One application, done once, and they could keep scaling without the cash drain. That's using debt strategically. Question number 5. Does this person add value beyond the money? This is the only question that might tip the scale towards equity. If someone is just offering cash, I would almost always say take the debt instead. Keep your ownership. But if someone brings a skill set you do not have, a network you cannot access, or capabilities that fill a genuine gap in your business, that changes the equation. I had a client who was technically brilliant but struggled with the sales. They brought on a partner who was a natural closer. Yes, they gave away equity, but that partner doubled their revenue in 18 months. That is a trade worth making. So the rule is, do not give away equity for cash. Give away equity for value you can't buy. Now, sometimes the answer is not debt or equity, it's both. A hybrid approach can work when you need the capital and capability at the same time. Here is how I usually sequence it. Debt first for assets and operational needs. This keeps your ownership intact for things that do not require a partner. Equity later, and only if you find someone who genuinely adds value beyond the money, or you structure a deal where a partner contributes both capital and expertise. They put in some cash and you finance the rest through debt, and they earn their equity through value they add, not just the check that they write. The key is never give away equity just because you need cash. Exhaust every other option first. Talk to banks, talk to non-bank lenders, look at asset finance, at invoicing finance facilities. If you have the assets on your balance sheet that are fully paid off, you can actually refinance those to get a cash injection without giving away any ownership. Most business owners don't know that's an option. Before I wrap up, let me give you the warning signs I look for. These red flags will set you apart from those that use debt wisely to those who sacrifice equity when they need it most. Signs you're about to take on too much debt. You don't have a cash buffer. You are financing operational expenses, not assets. You haven't stress tested what happens if revenue drops. Signs you're about to accept bad equity terms. You're giving away voting rights. You're diluting to the point where you lose control. Or you're signing a shareholders agreement that ties your hands up on every major decision. I've seen business owners sign agreements where the investor could veto hiring decisions, veto new products, veto basically anything. This is not a partner, that is a boss. And the biggest mistake of all, not having a shareholders agreement that clearly outlines what happens in a breakup. Because business partnerships do break down. And if you have not agreed in advance how that gets resolved, it gets ugly fast. Now, this decision sits on top of something more fundamental, which is understanding your cash flow and your numbers well enough to make it confidently. See you in the next video.